Good morning, good afternoon, good evening, everyone. My name is Immaculate Echerebo, and today I'll be presenting my research on the UK banking industry, focusing on how business analytics shapes decision making and financial performance. This presentation will examine key financial metrics compared to major banks, Standard and COA and Co, and provide recommendations for the future of the sector. Business analytics plays a crucial role in modern banking by providing efficiency, profitability, and risk management. This presentation will explore how data-driven insights impact financial performance using real-world comparisons between Standard and COA and Co. We will analyze statistic models such as correlation and regression to understand key financial trends and conclude with recommendation on how UK Bank can leverage analytics for future growth. Research suggests that organizations that effectively use business analytics outperform their competitors. According to Acito and Cohort 2024, highlights that data-driven decision-making provides operational efficiency, while Bresom at ALA 2021 found that firms using analytics achieve higher productivity and profitability. Key success factors include having a data-driven culture, high-quality data, and advanced analytical tools. Real-world examples such as Amazon and Capital One demonstrate how businesses leverage analytics for competitive advantage. Industry overview. Now, let's look at the key financial performance measures. This chart illustrates trends in return on capital employed and return on shareholder funds. We can see that ROAS fluctuates over the years but generally increases, indicating that banks are becoming more efficient in using their capital. There are some declines in 2019 and 2021, but a significant raise in 2023. Meanwhile, return on shareholder funds has shown steady growth since 2020, suggesting that banks are managing their finance more effectively. The faster growth in shareholder returns indicates a focus on increasing profitability and investment efficiency. Descriptive analysis. Now let's compare Standard and COA and Co. Standard operates at much larger financial scale with an average of £139.6 million compared to £39.5 million for COA and Co. However, Standard's financial figures vary more, as seen in its higher standard deviation of £57.9 million. This suggests greater potential for both risk and growth. Additionally, standard data is more stick way, indicating that it experiences more extreme financial value. The wider range in standardized figures suggests significant fluctuation in its financial performance, whereas COA and Co has more stable results. Correlation analysis. Now, this table highlights the relationship between key financial variables, the strong correlation between turnover and profit before tax of 0.88 suggests that higher revenue is stronger linked to profitability. Similarly, net tangible assets correlates highly with both profit before tax of 0.89 and shareholder fund of 0.90, indicating that banks with more physical assets tend to be more profitable and financially stable. Interestingly, return on capital employed and return on shareholder funds shows weaker correlations with more variables, meaning that these profitable measures are influenced by multiple factors beyond just revenue and assets. The strongest correlation at 0.96 S6 between return on capital employed and return on shareholder funds, showing that efficient capital use directly benefits shareholders. Now let's look at simple linear regression scatter plot. Now, let's examine the regression analysis, which helps predict financial performance. The scatter plot demonstrates a strong positive relationship between turnover and profit before tax, with an R-square revenue value of 0.7793. This model explains 78% of the variation in profits, meaning that turnover is a significant predictor of profitability. The regression equation indicates that for every unit increase in return over turnover, profit before tax increases by approximately 0.3781. However, some outliers in the scatter plot suggest that some firms experience significantly higher or lower profits relative to turnover, possibly due to differences in cost structure, efficiency, or financial strategy. Multiple regression analysis. This multiple regression analysis expand on this by incorporating additional financial variables. It confirms that turnover and profits before tax maintain a strong positive relationship. Net tangible assets are also closely linked to shareholders. Fund reinforming the idea that asset-rich banks tend to have stronger equity positions. However, return on capital employed and return on shareholder funds do not show strong correlation with other financial indicators, suggesting that factors beyond revenue and assets, such as market conditions and operational efficiency, affect these profitability measures. These insights can help banks identify financial strength and develop strategies to improve profitability. Now, recommendation. Standard that operate on a much larger financial scale, but also experience greater variability and risk. Profitability is strongly influenced by revenue and asset management. Business analytics enable better decision making, financial stability, and strategic growth. Now, based on these findings, I will recommend that UK Bank invest in advanced predictive analytics to anticipate financial risk and optimize capital allocation. Also, let them leverage AI-driven customer analytics to personalize banking service and increase customer retention. Again, let them implement real-time financial monitoring to improve decision-making and respond to market changes. And lastly, let them enhance data governance frameworks to ensure accurate, ethical, and effective data usage. By adapting these strategies, bank can enhance efficiently, minimize risk, and drive long-term profitability. Now, in my conclusion, business analytics is a powerful tool that enable banks to make smarter, data-driven decisions. My finding highlights the importance of revenue-driven strategy and asset management in achieving profitability. As the bank industry involves leveraging predictive analytics, AI-driven insights, and real-time monitoring will be key to maintaining a competitive edge. Thank you very much for your time.